Ladies and gentlemen, good day and welcome to the SBI Cards and Payment Services Limited Q2 FY23 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Rama Mohan Rao Amara, Managing Director and Chief Executive Officer of SBI Cards. Thank you, and over to you, sir.
Thank you, Faizan. Good evening, everyone. I extend a warm welcome to all of you. Thank you for joining us for the earnings call for Q2 FY23 today. Hope all of you had a great Diwali. It was pleasing to see the full festive fervor in the season after 2 years of caution-led restrictions. Buoyed by the festive zeal and driven by better sentiments on general economic situation and spending, the consumer confidence in the country has been on the recovery path. While the global economy continues to be turbulent, the Indian economy remains an oasis. Real GDP grew 13.5% year-on-year in Q1 FY23. Aggregate supply conditions have been improving. All constituents of domestic aggregate demand expanded year-on-year and exceeded their pre-pandemic levels. Supported by these factors, credit card industry has also seen encouraging overall growth. Credit card spends have been consistently crossing 1 lakh crore value for straight 6 months. Total industry spends were 53% higher year-on-year in September 22. As a matter of fact, September witnessed over rupees 1.2 lakh crore of spends due to an early start to the festival season. The total cards in force grew by about 19.5% year-on-year in September, but recorded marginal reduction on a month-on-month basis as the RBI norms on inactive cards kicked in. The industry has in fact seen interesting changes owing to new RBI regulations being implemented in 2 phases from July 1st and October 1st, 22 respectively. Industry witnessed a reduction in chip numbers as millions of inactive cards got closed. We at SBI Card have always maintained and pursued the strategy of fee-based cards. Since more than 95% of our portfolio consisted of spend or balance active cards, the effect on our portfolio due to this new RBI regulation has been limited. Our fee-based model has helped us in maintaining our 30-day spend active rate at 50% plus consistently. Regulatory change on over-the-limit charges have come into effect from 1st of October, impacting the OVL fee from this quarter onwards. October, November, December quarter onwards. We have initiated measures to mitigate the impact of this change. In short term, we will see volatility in industry card numbers, which is likely to stabilize in the next couple of months. The growth story of Indian credit card industry is intact, and the journey has just begun. Just to reiterate, credit card market remains largely underpenetrated. As per some reports, digital payments are accelerating in a big way and will constitute nearly 65% of all payments by 2026. Also, e-commerce continues to grow. It is expected to grow at the rate of 25 to 30% annually for the next 5 years. Most importantly, linking credit cards, particularly RuPay credit cards with UPI, will expand the use cases for credit cards. According to NPCI, UPI user base is likely to grow from current 250 million approx to up to 750 million in the next 5 years, giving credit card customers more options to spend. As we see today, we have many exciting milestones to achieve as an industry in the coming years. Let's now look at SBI Card's business overview in Q2 FY23. I am pleased to share with you that SBI Card continues to deliver a healthy business growth and strong financial performance. Our spend growth has been robust. Overall spends have grown by about 43% year-on-year in Q2, reaching 62,306 crores. Our spend market share stands at 18% for the half year, but exited the September month at 19%. Retail spends continue to grow strong at 45% year-on-year and stood at 50,895 crores. Corporate spends stood at 11,411 crores in Q2 with 34% year-on-year growth. During the past few months, we had undertaken an exercise to calibrate and review our corporate accounts portfolio, basis which we had exited a few low-margin accounts, resulting in moderation of the corporate card spend volumes. The increased e-commerce activities helped our online spends to grow. These now contribute a 57.8% share in the retail spends as of Q2, partly aided by the increased festive spends during the last 10 days of September month. In POS 2, we have seen a healthy growth, especially in categories such as electronics, hotels, restaurants, entertainment, and furnishings. Our revolver balances are rising in absolute numbers. However, the strong festival spends during the last 10 days of the September month has led to a buildup of transacted NEA, resulting in lower percentage share of revolver assets as of September end. We have seen a high conversion of these festive spends into term assets, similar to past trend lines. We have over 14.8 million cards in force as of Q2 FY23, and we added about 1.3 million new accounts during the quarter, the highest ever during a quarter. The market share in SIP stood at 19.1%. Our customer acquisition has also been aided by end-to-end digital journeys implemented for both our ETB and NTB customers, enabling customer acquisition at lower cost as compared to traditional channels. Our sustained growth during the quarter has been on the back of some key initiatives. We expanded our core card portfolio and introduced Cashback SBI card, an industry-first and most comprehensive cashback credit card ever. The card witnessed a high demand from customers, and we see it as a strong addition to our portfolio. We also introduced 1,600 plus festive offers pan-India. Along with national offers, we had also extended a large number of regional and hyper-local offers across 2,600 cities. Such initiatives have helped us maintain a higher share of active customers' portfolio and more engaged customers. Our 30-day spend active rate is at 50% plus. Our spend per average card has grown from 1.42 lakhs in Q2 to 1.71 lakhs in Q2 FY23. What is heartening is the increase in the average retail spend per card, growing from rupees 1.14 lakhs in Q2 FY22 to rupees 1.4 lakhs in Q2 FY23. At SBI Card, our customer-centric approach has always driven us to keep enhancing our customer's experience, and our SBI Card Sprint is the latest example. This end-to-end digital application platform enables customers to get a SBI credit card in less than 5 minutes. All these efforts have led to robust growth in receivables. Our receivables grew significantly by 41% year-on-year, reaching 37,730 crores. Receivables per card has grown to rupees 25,445 in Q2 FY23 from rupees 21,257 in Q2 FY22. SBI Card has been very active on ESG front. I am extremely happy and proud to share with you that we have seen a significant improvement in percentile in Dow Jones Sustainability Index evaluation, leading to an improved performance overall by SBI Card. I would like to reiterate that we have always kept a sharp eye on the sustainability of the business, ensuring viable business practices throughout. We are committed to enhance our efforts in this direction so that we are able to positively impact more and more lives. Please allow me to now to take you through the financial performance in Q2 FY23. Our resilient business model, embedded on strong fundamentals, have helped us deliver healthy, profitable growth. The company has achieved a PAT of rupees 526 crores in Q2 FY23, a growth of 52% year-on-year. Cost to income ratio at 59.4% is driven by investments to drive business growth in terms of higher volume of new accounts and to drive higher spends during festive season. The cost to income is expected to remain at elevated level as festive period is continuing in Q3 FY23 and with our continued focus on increased new customer acquisition. In Q2 FY23, receivables stood at 37,730 crores with a growth of 41% year-on-year. Total revenues stood at 3,453 crores and have grown at 31% year-on-year during the quarter. On asset quality front, our gross credit cost percentage for the quarter is at 6.2%, up from 5.6% in Q1 FY23. The increase is largely driven by the increase in phase 1 assets. Our GNPA has come down to 2.14% as compared to 3.36% at Q2 FY22 and 2.24% as at Q1 FY23. Net NPA for the period is at 0.78% as compared to 0.91% at Q2 FY22 and 0.79% as at the end of Q1 FY23. Return on average asset for the quarter ended September 22 is at 5.4%, which is higher by 41 basis points as compared to 4.9% for Q2 FY22. Return on average equity is over 24%, which is again higher by 404 basis points as compared to over 20% for Q2 FY22. Our liquidity position continues to be strong, and the capital adequacy is at 23.2% for the period ended September 22. We maintained the LCR at a healthy 82% through the quarter. Owing to rising interest rates, the cost of funds has increased from 5.1% in Q1 to 5.4% in Q2 FY23. The full impact of higher rates will be further felt in the subsequent quarter. In conclusion, due to global disturbances, the external environment continues to be volatile. Though the domestic economy has been able to deal with these disturbances, it is still pertinent to be watchful. We remain optimistic about the future and believe there is plenty of room to expand the company's portfolio, generate consistent profitable outcomes, and increase the value to all our stakeholders. With the festive season and the upcoming holiday season, we hope to also see a good traction in consumer discretionary spends. Having said that, we continue to maintain a cautious approach and take calibrated measures as the situation calls for in the future. So, Faizan, now we are open for questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Ladies and gentlemen, in order to ensure that the management is able to address questions from all participants in the conference, please limit your questions to 2 per participant. Should you have a follow-up question, we would request you to rejoin the question queue. The first question is from the line of Anuj Singla from Bank of America. Please go ahead.
Yeah, good evening, everyone, and thanks for the opportunity. The first question is on the NIM's outlook. So when we look at the NIM for this quarter, 12.3%, this is a multi-quarter low, obviously reflection of the higher transactor and the higher funding cost as well. So when we look at the drivers for the upcoming quarters, the funding cost is going to rise and probably offset by improvement in the asset mix. Can you guide us how should we looking at the trend in this number maybe over the next couple of quarters? When can we expect it to maybe increase to 13% or more in the coming quarters?
Yeah, Anuj, you are right. I mean, given the kind of propensity for the funding cost to increase further in the next quarter, because the full impact will be felt in the next quarter. During the quarter, of course, there will be an opportunity to transmit the increase in the funding cost also to the extent possible, and some correction in the base or normalization of the base will also happen with the festive spends maximum lasting up to end of October. Some repayments will be there, so some base normalization will be there. We are confident that it will be more or less maybe with a 10-20 basis points here and there, it can be around the same range. That is what we are expecting.
Okay, in terms of cost of funding, is it possible to give what kind of number we can see, increase we can see in the next quarter?
I did not get you, Anuj. Can you repeat?
Sir, cost of funding, what kind of increase can we see in the next quarter? Sequential increase in the cost of funding.
Cost of funds can increase by up to 40 to 50 basis points minimum. But of course, what is shown in the deck perhaps is also colored slightly by the base effect also. Base also has a bearing. While we have actually seen a 50-60 basis points as guided in the last quarter, full impact is not felt. It is only like a 5.1 increase into 5.4%, which is more of a base effect. Some of this effect will fade away. So we are expecting another 40 to 50 basis points increase minimum in the cost of funds.
Okay, got it. So second question is on the SBI Cashback Card, obviously a very great product. And some of the best cashback available in the market right now. So 2 things there. One, is there a number in mind as on absolute side or as percentage of outstanding cards, where you would like to cap the contribution from this card as percentage of maybe or number of cards outstanding? And secondly, again, the question to Girish on the economics of this card, that is one of the key, concerns, that this is gonna be ROA dilutive. So, and any color you can provide that.
I think we are in the early stage. Our attempt is to first iron out all the kinks that are there in the journey and smoothen the process. And of course, we also need to figure out what is the right way of reaching out potentially to the new customers, the NTB kind of customers. I think it's too early to speculate like what is the percentage, but definitely we would like the volumes to increase, and that's the reason we put it on a scalable platform like a digital platform. But Girish will update on the ROA dilution.
First of all, the numbers have just started. It's not. We already have a base of almost 1.48 crore cards. So 14.8 million is already there. So this number is not even in, as of now, not even in hundreds of thousands. So it will take its time to grow the portfolio. Second thing is, as we had updated last time also, we had looked, when we were looking at the overall profitability of the product, so we have put this product purely for customers who come through digital channels only and do straight through processing. We are seeing the benefits of that also. Almost the active rate, monthly active rate, even though this portfolio is very new, is upwards of 70% plus for these customers. These customers are very active. They are using the card. We are seeing better spends per card. So once we build a portfolio of at least 200, 300,000, we will be able to see the behavior and accordingly take whatever, if there is required, any action which is required, we will take. But as of now, as per our plan, whatever we are saving in the cost of acquisition, we are putting it back as a customer value proposition.
Thank you. Mr. Singla, may we request that you return to the question queue for follow-up questions. Thank you. The next question is from the line of Nilanjan from Nomura. Please go ahead.
Thank you for the opportunity, sir. I hope I'm audible. A couple of questions. So first is on the ECL. While you mentioned about the higher transactor leading to the stage 1, but there's also a footnote which talks about some impairment. If you could explain that and the quantum of that. The second is if you can talk about let's say the revolver balance on a quarterly average basis. So basically trying to exclude the last 10 days of spends. And how would that then compare to, let's say, the 26% that we reported in the first quarter? Also, if you can, briefly touch upon how the spending in the September and, early October is converting between EMI and revolver. And finally, if you can talk also about the lower employee cost sequentially and if there has been a change in the headcount numbers.
Yes, I will take this question on the revolver. As I said initially in my speech also, the last 10 days of September witnessed a very good growth in the spend on account of our campaign with Amazon. If we normalize it, if we take out the kind of spends over and above the normal run rate what we see, the revolver share will almost be equal to what we had at the end of the June quarter. So that way it is stable. We have seen a kind of growth in the absolute amount also, but obviously the growth is not in tune with the asset growth, overall asset growth. That is the reason for the decline in the share. But a kind of some ballpark estimates do indicate like the percentage of customers who are revolving is more or less stable. That's not a concern. But revolvers being slightly stagnant is a kind of industry phenomenon. But in terms of taking necessary steps, whether we have taken necessary steps or not, we have taken all necessary steps. You would have seen from the investor deck also that we are permitting more of a self-employed and Cat B kind of customers who have better propensity to revolve. We are hopeful, but the pace at which we were expecting, obviously, that's not the case. It's taking a longer time, like the entire industry. Easier question will be taken by Aparna. Yeah.
If you're referring to the footnote on the asset quality page, that's a small number of 2 crores or that relates to other assets, which is not the basic credit card receivables, it's some other operational assets that we get.
Right. There's also derecognition. What would that be?
So these are security deposits, right?
These are other assets where provisions have been kind of taken, so that's what it is. If you look at our overall impairment losses of the 996 for half year, 994 relates to credit cost.
It's a small number. It's for some other operational assets that we get. That's all.
Okay. And the final one on the employee cost, please, and the headcounts, if you can.
I think employee cost, if you're comparing quarter on quarter, the marginal reduction is perhaps payout of PLP perhaps in the first quarter slightly would have.
So I'll just add to what Sir is saying. There's no change on headcount. In fact, it's marginally higher. The reason you're seeing that a little lower is our PNB cost is largely flattish. There is a change in actuarial estimates on long-term employee benefits. This is what is causing this to come lower versus last quarter.
Any quantification, if at all possible?
We have that 10 crores, right, versus last quarter.
Okay. Perfect. Thank you so much.
Thank you. The next question is from the line of Dhaval Gada from DSP Mutual Fund. Please go ahead.
Yeah. Hi, sir. Thanks for the opportunity. Two questions. First is relating to revolver book. So it's been, like almost 1 month from the quarter end. If you would give initial perspective of conversions into EMI and revolver, and so that would be first question. The second is on the sourcing. So could you just provide some color on how the September sourcing was? And in terms of contribution of direct sourcing in that, since we just break it between banca and open market, just if you could split that into direct as well, that would be useful. So what kind of run rate we ended the quarter, and your commentary around how it's likely to move forward, and the sourcing mix between direct and other sourcing. Thanks.
Yeah, Dhaval, I will take the question on the sourcing. I think we exited the quarter, particularly in September, with a gross issuance of more than 470,000 cards. It was contributed from a SBI channel around 40% in the month of September. As we said, as we guided in the past, from the month of July onwards, again, the banker sourcing started improving. We have been seeing improved traction. Both August and September, we had around 40%. Now it is actually trending at 43-44% in terms of share in the overall sourcing. Coming to, of course, with regard to what is the kind of numbers we are looking at going forward, our stated stance is we wanted to target a net growth of 300,000 cards, which we almost achieved in the month of August when we reached around 296,000 net growth. But later it is colored by some kind of attrition where we ended up reporting a roughly minus 3,000 kind of growth in the month of September. But again, October onwards also, we are expecting the volumes will continue, and our expectation that we will continue to have a net growth of 300,000 minimum. That aspiration is there, and we are confident of reaching that. On the revolver.
Yeah. Because this festive season started somewhere around September 23rd, 24th, when the season sales started. So what we have seen is the spends number is already updated. We have seen very good spends continuing in the month of October. So the festival season has been very strong till Diwali. The percentage of spends converting into EMI is higher than normal, because earlier, as we had said, we updated that we would see a 10% conversion into the EMI. This time it is, because it's festival season as well as more discretionary spending and more consumer durable spending happens. So we have seen a far higher conversion into the term balances. Revolve we will get to see in the month of November only, because it has to take 40-45 days and a payment cycle plus payment due date to be able to figure out how the payments have come back. So we will be able to see that by mid of November to be able to report how much of that is going to revolve. And as MD sir mentioned, even in absolute terms from June to now, the revolve balances have actually grown. It is because of the denominator impact that the percentages are looking.
Understood. Thank you and all the best.
Thank you. The next question is from the line of Ajit Kumar from Goldman Sachs. Please go ahead.
Thank you for taking my question. So couple of questions. One, on the
Mr. Kumar, sorry to interrupt you. Please use the handset mode. The audio is very low.
Am I audible now?
Yes, sir.
Okay. So first question is on the attrition rate. Your attrition rate in both set of portfolios, whether it is open market or SBI portfolio, has gone up significantly in this quarter. And as you said earlier, impact of RBI circular on inactive cards have been limited for you. So what is driving this high attrition in the portfolio?
I think during the quarter, you can make out for the kind of volumes what we have given versus what was the cards outstanding between both the quarters, last quarter and current quarter. We have around more than 7 lakh card kind of attrition is there, out of which around 3.6 lakhs is on account of, the cards which are inactive for more than 12 months, we have closed. 3.6 lakhs.
3.5 to 3.6.
Yeah, 3.5 to 3.6 lakhs. The remaining is the normal BAU attrition what we have on account of both voluntary as well as involuntary.
Okay. Thank you. And the second one is on the interchange fee. So interchange fee as a percentage of spends has marginally gone down in this quarter to 1.38%. It used to be in the range of 1.5 to 1.6 pre-pandemic. So when the large ticket size spends such as travel is back, why is interchange fee not going up?
I think interchange fee at the aggregate level is also a function of corporate card spends, which typically have a higher interchange. And as you would have seen, a quarter-on-quarter basis, the share of corporate card spends have come down. So that majorly explains.
But on retail, the interchange has actually gone up because the travel component is stable in Q1 versus Q2, and e-commerce has grown. So on the retail, the interchange has actually gone up. The impact, as Sir said, is primarily because of the lower corporate spends.
Okay. And any reason why corporate spends have come down?
I think we said in the past also that competition intensity is very much there and it is impacting the margins also. So we are revisiting our strategy for the last few months. So we exited a few low margin or a kind of negative kind of relationships and we are recalibrating our strategy. So in the long term, at least in the medium term, we would like to take the share again back to 22 to 25% of the overall spends, but in a very calibrated manner, we will improve the share of corporate card spends.
Okay. Thank you. Thanks a lot.
Thank you. The next question is from the line of Abhishek Murarka from HSBC. Please go ahead.
Hi, sir. Good evening. My first question is on slide 10. If I look at the spend categories, especially the POS spends, category 2, 3, 4 are all lower on a YOY basis. Also, category 4, which is travel agents, hotels, airlines, again, that is lower 5%. The total spends in that is lower 5% YOY. So why are these lower? The basic understanding was that spends are picking up across the board and also on at the POS. So can you explain this?
So first I'll come on the travel piece. April, May, June is typically where the travel season is there. So the seasonality typically is that you will get higher spends in the April, May, June quarter and then again in the November, December, January period. So that's the standard seasonality. What we have seen, however, is that the decline in travel has not been what it was used to be pre-COVID numbers. So actually, travel is going fairly strong in terms of both lodging, airlines, and all categories. So 5% is hardly, what I would say is more or less stable in this category. Okay. On the point of sale spends.
Sorry to interject, but so this is Q2 FY23 over Q2 FY22. So this is not a quarterly comparison, right? So there would not be a seasonality impact here.
So I think there is a typo there that we will have to correct it. It is, I think, over Q1. Okay, last quarter.
Okay.
Because overall, this is a total spend on each category is that. So we will it's a typo this too. Thank you for pointing that out.
Okay, sure. And what about POS spends? Again, that has come down QOQ if this is QOQ data.
Yeah. So overall, if you look at it, POS spend has gone up in this category, which is consumer durable, apparel, and because travel is mostly an online category. But in consumer durables and apparel, most of it has moved to online. So if you look at it, online growth in consumer durable is in 39% and 212% because a whole lot of e-commerce spends also gets categorized as apparel. So online spend is increasing there.
Right. And just as a clarification, the interchange between online and POS would be the same, right? Because it's on an MCC basis. So.
Yes, absolutely. MCC as well as the kind of card which is being used.
Yeah. Perfect. Okay, so that explains this. The second one, sir, is on yield. Now the drop in yield, partially it would be explained by the mix of transactor, revolver, and all of that. But there was also a regulation which said that you can't charge penal fees, late fees, etc. From the date of making the purchase. You have to charge it from the date it becomes overdue. Have those regulations also impacted your yield overall?
I think the measures relating to, which have some potential impact on the revenue, they came into effect only from 1st of October. So RBI has given slightly extended timeline of 3 months for those measures. So September quarter will not reflect any of those changes. But something to do with the capitalization, all that stuff, I think they came into effect from 1st of October. So the full impact, September quarter results will not have that. We are yet to see unless we see considerable period in the quarter, October, November, December quarter, we will not be able to comment on to what degree this impact will be there. But definitely there will be marginal impact will be there, definitely.
Right.
But to what extent that impact quantification will take time.
But so you would have done some sort of analysis or some sort of estimation of the kind of impact, because if you have to offset it, you would need to know what kind of impact is going to come. So any kind of ballpark indication would be helpful.
Materiality-wise, we have called it out clearly because the OVL fee is the one where we saw a kind of impact. In fact, it accounts for just like a 5 to 6% of the overall fee-based income, where now there is additional step involved before you permit over the limit of taking an explicit consent from the customer. So initial days, any such kind of measure, I think unless the customer is aware or consumer is aware, they will not be able to exercise the option. So that one we have actually taken note of and called it out very clearly. It will take time to claw it back. The rest of the things, it's too early to comment. At least we did not consider them to be very material. While definitely there will be some marginal impact will be there, negative impact will be there. But the one which stands out is the OVL. Where also we are looking at a kind of how do we create a kind of convenient customer journey where giving that consent or taking the consent from the customer becomes easy. We have been exploring. So we are confident of clawing back most of it actually over a period of time.
Got it. And then just one quick question in OPEX, is there any kind of one-off?
No, nothing.
Okay.
No one-off. Just that I think it has an impact of higher sourcing which is there versus last quarter. Our sourcing of new accounts has gone up. However, the impact is not in a similar range because our utilization of digital channels and overall PO is trending lower versus last quarter.
Thank you. Mr. Murarka, may we request that you return to the question queue for follow-up questions. The next question is from the line of Piran Engineer from CLSA. Please proceed.
Yeah, hi. Thanks for taking my questions. Just a couple of ones. Firstly, you mentioned that 10% of your spend convert into EMI. Can you give a similar breakup for, how many convert into what percentage of spend eventually revolve? And also what percentage of your customers have ever revolved?
So on a percentage of spend going into revolve, that there is no specific way to close that number because there are customers keep changing from transactor to revolver on a month-on-month basis. So the payments keep coming back, and these days, because a lot of EMI options are already available in front of the customer because from a payment due date. So customers revolve as a short-term funding requirements for themselves. So the movement between customers changing from revolver to transactor and transactor to revolver also, both ways, it's quite substantial. We have not declared, now we internally analyze, but we have not declared ever revolve customers or fully transactor customers, but there are set of customers who are, let's say, continuously transactors, and there are a whole lot of customers do revolve occasionally. Well, you can call it 1 time, 2 times, 3 times. There are some sloppy payers also who will forget to make the payment, end up revolving, come back in the next cycle. So some of that continues to happen.
Got it. And so the next question is maybe a very basic or stupid question, but now if someone has, say, a Simply Save or Simply Click card, and then he wants a cashback card, so do you then lower the credit limit on Simply Save, or do you simply, have to cancel one of the cards? Just want to get a sense of whether a lot of your existing customers itself will, in a way, upgrade to the cashback card since it's such an amazing one.
I think customer will have an option of flipping it if he feels like he's better off actually closing the card and then opting for completely cashback card. Or otherwise, they can split the existing limit. Or at the time of exercising this option, if they're eligible for a higher limit, he will get the incremental limit on the new card also. So it all depends on the customer profile actually.
So broadly, if you could give a sense, of the 100,000 or so customers you've given this card, how many are just from our existing base and how many are truly like open market?
No. So we did not. First of all, that there is no 100,000 number at this point of time. So let me clarify. Okay, we have not given the numbers out as of now. The point initially was being made was that this cashback card portfolio is not substantial enough at this point of time to make an impact on the overall portfolio. So that is point number one. The second point here is that, as sir was mentioning, the customers, it is a choice of the customer. Second, also you have to note that Simply Save and Simply Click cards are at 500 rupee annual fee, and cashback card is at 999, and the spend-based annual reversal is also at a higher value. So there will be customers who will be switching over and taking it, but in our whatever trends that we are seeing for the initial lot of customers, we do not see more than 10 to 15% of the existing customers coming in. Most of the customers are new customers which are coming in, and that was the whole idea. We were targeting customers who have e-commerce specific cards with other banks, and they are taking one card with one bank, another card with another bank, and third card with third bank. It is to that population, younger segment, that we have targeted this card, that with one card you should be able to utilize this benefit across the e-commerce platforms.
Thank you. Mr. Engineer, may we request that you return to the question queue for follow-up questions. Thank you. We'll take the next question from the line of Karthik Chelappa from Bona Vista Fund Management. Please proceed.
Yeah, thank you very much for the opportunity, sir, and related Diwali wishes to the management team. 2 questions from my side. The first one on the revolvers. Assuming we normalize it for the spends, said it is stable quarter on quarter. Could you give us some qualitative on when you look at the cohort of revolvers? Those who revolve.
Is breaking from your line, sir. Please check.
Sure. Is this any better?
Sir, it's still the same.
Hello? Okay, give me a minute. Is this any better? I'm actually increasing the volume to almost the full. Okay, great. Sir, my question is basically on the revolvers. Even if you normalize for the spend increase towards the end of the quarter, when you look at the cohort of the revolvers, those who revolve once a year or 3 times a year or 5, 6 times a year, at which cohort do you think the deterioration has been the steepest?
So it's even across all. I don't, there's no one particular category where this is. It's still in line with the overall distribution. There's no particular one that we call out and we've seen any more than normal decrease or increase in that.
Okay, got it. And to the point on the new sourcing mix, where you're actually seeing category B rising as well as self-employed rising, if I couple that with, let's say, your 2.14% gross NPA and a provision coverage north of 60%, can we say that your credit risk appetite is actually improving at the margin?
So that, if you recollect, that is something we've been saying now for the last 1 or 2 quarters, that whatever cushion that we have built up on the credit cost, we are using that to test a few segments. And that is evident with the increased self-employed or the category B sourcing. That's a conscious decision. However, I think it's important to note, like you said earlier, this will always be calibrated. We will test the segment, see how it does, and only then expand it. We are not going to do anything in a very rash manner.
Thank you. Mr. Chilappa, may we request that you return to the question queue for follow-up questions. The next question is from the line of Pankaj Agarwal from Ambit Capital. Please go ahead.
Yeah. Hello, sir. Am I audible?
Yes, sir, you're audible.
Yes. So what explains this 200 crore jump in operating expenses on QOQ basis? It's roughly 19% QOQ, and if you look at any other parameter, whether your spends or whether your new card origination or even loan book, that's not increased by the same margin. So, from where this extra OpEx is coming in this quarter?
Sure. So, as you said earlier, it's driven by 2 things broadly. One is our new account sourcing has gone up. It's up about 44% versus last quarter. And second is our spend-based cost is running higher because we participated in the festive campaigns with e-commerce partners. So those 2 are the factors which are driving the cost to be higher versus last quarter.
Okay. And right now I think you are roughly at 59% cost to income in this quarter, right? So once, let's say, your new additions comes down and all these festive offers are over, do you think you can manage your cost to income at roughly 55 to 56%, which was like pre-COVID levels?
So I think, sir, Andy sir said initially that the festive period this year is continuing from Q2 and extending to Q3. So the cost income will remain elevated. That's what was initially mentioned. However, as the festive period comes down, our cost income should come down because our cost should come down. However, our focus on new account sourcing will continue and those costs will come in. We'll see efficiencies coming in because our new account sourcing is coming at a lower cost compared to past due to our focus on digital sourcing.
Okay. And one more question about your credit cost. It has gone up by roughly 55 crores QOQ. So, though your overall mix of revolvers are still down QOQ, though it's up on absolute basis, but as a percentage of non-book it's down, right? So, what explains this extra credit cost during the quarter?
So you have to look at 2 or 3 numbers together, okay? So credit cost is only one of the indicators, and yes, the credit cost has gone up quarter on quarter. The way to look at it is 2 things. One, the new book that comes in the stage 1, we will obviously provide for it, and the repayment will obviously take some of it will come only over a period of time. However, we will be booking up the stage 1 provision. Okay. The other piece is that as we have recalibrated our risk appetite, we have seen some degree of increase on the stage 3 also. However, please read that number in conjunction with the SBI number as well as the ECL rate. If you look at our ECL rate, which is a better indicator of what we are expecting in the future, or the quality of the portfolio, the ECL rate has been stable at 3.3 now. Pre-COVID, that number used to be in the range of 3.5 to 3.75. So, like I said, we have been taking a few steps in terms of expanding our risk appetite. However, nothing has yet impacted the quality to that extent. The way to look at credit cost is more on a range basis and not at a number at a particular quarter. That is the point we've been making. We used to operate at 6.5 pre-COVID. We will see the number move in a particular range over the next 2 quarters.
Thank you. Mr. Agarwal, may we request that you return to the question queue for follow-up questions. The next question is from the line of Param Subramanian from Macquarie. Please proceed.
Yeah, hi. Thanks for taking my question. My question is actually an extension of the last question that was asked. So on provisioning, so on percentage basis, why has the credit cost increased quarter on quarter? Basically, I picked up some explanation on stage one assets, but that has inflated your denominator as well. So I didn't understand why the 5.6 has moved to 6.2% quarter on quarter. And also, 6.5% was your pre-COVID credit cost, but that was on a revolver base of like 37-38%. Considering it's at 24% now, so then this be much lower. That's my first question. I'll come back on it.
I think, Param, the stage one is provided at 1.7%. Even though the stage one is a kind of transitory which may either revolve, some part of it may revolve, some part of it may convert into some kind of flexi-pay EMI-based loan. Most part of it may get repaid during the quarter, during October, December. Still, we provided 1.7%, which in annualized terms has an effect of almost like a 6.8% over a base rate of 5.6%, whatever was there in the previous quarter. So this has an effect of momentarily increasing the percentage cost.
So, sir, if I understood correctly, so this should reverse over the next quarter, right? Because we've seen a very abnormal last 10 days, right? Is that the right understanding?
Absolutely. So to the extent stage one NEA comes down, to the extent you automatically get a relief.
Got it, sir. So my next question is on the over limit fee. You touched upon that, saying it's 5 to 6% of the fee income. But any analysis you've done on how much could be the EPS impact that we could see or because of this coming into effect from Q3 onwards? And also on the OPEX trajectory, how much of the increase in the OPEX trajectory that we're seeing is more structural, considering we've moved to a higher run rate of net issue? Yeah, those are my questions. Thank you.
I think we have not computed anything on the EPS front. You were talking about impact on the EPS. I gave a kind of quantification based on the current run rate, what we see as a monthly, which we did not disclose earlier. So that's the reason we wanted to clarify that 5 to 6% kind of OVL is there. This is not permanently lost. I mean, as I said earlier, we are figuring out what is the right way of creating a right journey, which is convenient for the customer to express his or convey his mandate. So we are confident of drawing it back. But of course, we will also be constantly looking for opportunities to realign our pricing in line with the competition wherever opportunities are there. Already you would have seen like we have already come out and communicated to the customers around charging some fee income for the rental, which is in line with other players also. So those opportunities anyway we will explore. So overall, we don't feel it is a complete loss or anything, but it will take some time for a complete clawback.
Thank you. Ladies and gentlemen, please limit your questions to one per participant. Should you have a follow-up question, we would request you to rejoin the question queue. The next question is from the line of Nitin Agarwal from Motilal Oswal. Please go ahead.
Yeah, hi. Good evening, everyone. So I have a question around the revolve rate on the self-employed segment. Now, as a strategy, we have been increasing the mix of self-employed. This segment share is at 30% for the quarter versus 17% at the portfolio level. So just curious to know what is the proportion of revolve rate in this segment, so as to better understand how this approach can help.
So listen, the self-employed portfolio tends to revolve higher. So, and that's something that we've noticed, and that's generally the case. So whether it is the second-tier salary or the self-employed, the propensity to revolve is higher, and that's continuing. And that's one of the reasons why when we said we've gone back and recalibrated the risk appetite, we brought some of these in just to be able to see how they perform.
Right. I understand that, but sorry, if you can just indicate some range as to what is the typical revolve rate in this self-employed category that you have seen over the last couple of years.
We haven't given the segment level revolve rate. Like I said, it is higher than the salary. And again, even within salary, obviously the government is lower and the second-tier salary is higher. Self-employed is higher than that. So we haven't really given the segment level revolve rate.
Okay. And secondly, a very small question is on the economics of the newly launched cashback card, how do you really see that? Will this product take longer time to scale up on the profitability curve? Any thoughts around that?
So as we had stated earlier, when we looked at the economics of coming out with a card like this, we in the present scenario, we looked at the cost which had to be incurred. So for example, cost of participating with a co-brand partner, payout to the co-brand partner, cost of acquisition, we took all that and decided to convert it into a customer value proposition. Okay. So that is why this card is only available when the customer applies on their own through digital channels. So thereby we save a majority of our cost of acquisition. We are also saving monies which could have been a potential partner payout, which is quite substantial in these days. The third part is that it also gives us strategic freedom to be able to tinker with the product at some date, looking at the way the consumer behavior is happening. Given these three parameters, we came out with this product. When we look at internal parameters, we see that the profitability is similar to what we see on a Simply Save or a Simply Click card. Now, you have to also note that Simply Save and Simply Click card are a 500 rupee product. This product is available at this point of time, first year free till March 31st, but it has an annual fee of 999 rupees.
Thank you. The next question is from the line of Rohan Mandora from Equirus Securities. Please go ahead.
Good evening, sir. Thanks for the opportunity. Sir, could you share what was the fresh delinquencies in this quarter, and also the provision number, if you can split between stage 1, stage 2, stage 3?
So if you just go to the asset quality page, we've actually given the provision number also on that. So I'm not sure I understood the question. The question is on what is the delinquency?
Fresh NPA creation during the quarter. Fresh slippages.
So the increase in stage 3 is largely made up of mostly fresh slippages only. We've not given the split. If your question is on the slippages, then we'll get back to you with a specific number. It's not part of this. However, overall, if you look at the GNPA, the number is at 2.14, which is down slightly from last quarter.
Sure, I'll touch base separately for the fresh delinquency number. And the provision that we have done in this quarter, how is it split between stage 1, stage 2, and stage 3?
So I think we've given the rates. If you look at it, the stage 1 book, we normally provided 1.7%, and stage 2 is about 5.2%, and stage 3 is at 64%. So that's the breakup, and it's already available. If you look at, we've given you the breakup of the stage of the receivables as well as the provision rate. So that breakup should be very easy to calculate.
Thank you. The next question is from the line of Shweta Daptardar from Elara Capital. Please go ahead.
Good evening, sir. Thank you for the opportunity. So my question is on subscription-based fee share, which is standing statement if I compare both Y and Y Q-on-Q basis. So any color on this vis-a-vis the new account sourcing, and also, if we could attribute this to any spend-based reversals that might have happened, which would have offsetted this and led to marginal decline.
Shweta's question is not clear. If you can ask again.
So my question is on subscription-based fee share, which is standing statement if I compare both sequential as well as on annual basis. So any color on this vis-a-vis your new account company sourcing, or should we attribute this to any spend-based reversals that might have happened?
So, Shweta, I think we answered this earlier, also came last quarter. So this is linked to the higher share of spend-based reversals, which is coming in, due to which the subscription-based fee is marginally lower.
Sure. And so if I might squeeze in second question, you mentioned because of the new RBI norms, 95% is where you're standing in terms of active portfolio. So do we see from here on the CIF improving month-on-month basis, and that the impact is almost behind?
Yes. So in the month of September, we have taken, if you notice that we reported a steep decline of almost around 3,000 cards. So while we did, as MD sir mentioned, 4,70,000 plus new cards. So in the month of September itself, we have taken the complete impact of the RBI guideline and closed all those cards. From now onwards, October onwards, we should see an increase, and we are targeting at least 300,000 net growth on a monthly basis.
Thank you. The next question is from the line of Shubhranshu Mishra from Phillip Capital. Please go ahead.
Hi, sir. Thank you for the opportunity. Could you please split out the revolvers into accidental revolvers, periodical revolvers, and chronic revolvers with their loss rate? And the second question is around the category 4, where the travel, hotel, airlines has come off even on a QOQ basis. So all these rates have actually gone up. And if you look at the airport authority data, the domestic arrivals, international arrivals, departures have all increased on a volume basis. All the hotel rates across travel websites are at their peak. So it seems quite out of whack that the category 4 spend should come off even on a QOQ basis, because the crude has also gone up. So the travel tickets have escalated even on a QOQ basis. So if you could throw light on these two questions. Thanks.
So I'll first answer the travel category. So the category 4 here is travel agent, hotels, airlines, railways, entertainment, and restaurant. We clubbed this all together as more as a travel and entertainment as a category. However, travel itself and lodging itself are the large components of these. Okay. Now, while in April, May, June quarter, the travel bookings, a whole lot of travel bookings happen at least 30 to 45 days prior to when the people are traveling. So this seasonality, what we have seen is what you see actually on the ground, the bookings happen slightly earlier on that one. So in the past, what we have seen is pre-COVID, that May, June and November, December are the high seasons of ticket booking. So, ticket booking starts on April or so, and by the end of May and early June, most of the ticket bookings get done. Similar trends you see by the November or so. Regular travel, emergency travel, all that stuff will continue, but the children holidays and the leisure travel typically follows these patterns.
Right. The first question.
We've not really shared that split of revolvers into those categories in the past also. I think we only shared it on a total basis.
All right. So, thank you. Best of luck.
Thank you. The next question is from the line of Mohit from BOB Capital Markets. Please go ahead.
Yeah. Thanks for the opportunity. My first question is towards the active rate. If you look at the active rate for the quarter was 50%, which was, the same as the previous quarter. So because of the festival season, we haven't seen any increase in the active rate. So any, expectations on that which would not have been met.
So active rate in September has gone up, but because we have given her the quarterly number, and we saw higher activity in last 7-8 days in the quarter, in the last quarter. But if I talk about July, August, and September, August was better than July, and September was better than August. So that has been the trend line.
Perfect. Just using one more, if you look at the retail and corporate spend. So earlier it used to be around say 76-77% retail and 22-23% corporate. But as you said that you have
Mr. Mohit, please repeat your question. The audio is not clear from your line, sir.
Hello. Yeah, is this better?
Yes, sir. Please proceed.
Yeah. So seeing that the share of retail and corporate, if I talk in terms of spends, used to be around 75-76% retail and the balance 23-24% corporate. But now that your certain corporate spends have come off, the ratio looks very skewed at 82% retail and 18% corporate. So going forward, should we expect that this ratio will continue?
No, as I said earlier, we are targeting a kind of, again, improvement and taking it back to the earlier level, but in a calibrated fashion. Because as I said, because of the competition intensity, some relationships are not working. More like they have become more like a cash burn, and we don't want to be in that game. So that's the reason we have actually exited some relationships. But at the same time, we are building the pipeline. So we are confident of taking the share back to the earlier levels over a period of time.
Thank you. The next question is from the line of Jay Mundra from BNK Securities. Please go ahead.
Yeah, hi sir. Thanks for the opportunity. I wanted to check, sir, on your cost of funds, which you have said that you are expecting 40 to 50 basis points. Is this your total cost of funds, or you are saying about the cost of funds from banks? So, and specifically, sir, would it be fair to assume that all your bank loan would be on, would this be on MCLR, or you would be drawing from T-bills or maybe EBLR?
I think our sourcing, particularly, we have given the profile 35%, 34% is from long term, and the remaining are short term. Short term is the bank lines which are linked to external benchmarks. It can be a treasury bill or it can be repo kind of rate also. But short term is mostly linked to the treasury bill kind of rate. So depending on the movement and depending on the tenor at which they are availed, they will get reset. With regard to your other question on the cost of funds, which we have given as 5.4%, that is the cost of borrowing on an average for the entire portfolio, right? You want to add something?
Yeah, I think just to add what Sir said initially was that 5.4 also is little colored because of the base effect of the borrowing the last 1 week. As we said in the last quarter, it should on a apple to apple basis, it should be in the range of 5.7 for this quarter. And for next quarter, Sir already said that it will be higher by 50-60 basis points.
Thank you. The next question is from the line of Mohit Surana from CLSA. Please go ahead.
Hi, sir. I just have one question is, how has, in your open market sourcing, what is the percentage of customers that are new to credit? And if you can also comment in terms of how it has trended over time.
Generally, it will be very low because generally we get more of NTCC and NTC from the banker channel, where we have the comfort of looking at their financial transaction profile, etc. In the case of open market, it is negligible. Mostly it will be either to some extent it will be NTCC, but predominantly it will be like a credit tested kind of customer.
Okay, sir. Thank you.
Thank you. We'll take the last question from the line of Dhaval Gada from DSP Mutual Fund. Please go ahead.
Sir, thanks. So just two clarifications. One relating to the full year cost to income. So I remember in the fourth quarter call you mentioned that this 57% kind of zone is where we target, and then there could be quarterly volatility in the cost to income. Is that the same thought process that you have at the moment, give or take some percentage point? Or it could be meaningfully higher, just some clarification around that. And the second one is just on cost of funds, again, I'm a little, just to be a bit more clear, in terms of where we ended this quarter, we should see another 50 odd basis point, 50 to 60 basis point increase in the next quarter. Is that correct?
Yeah, coming to your cost to income, when we guided in the past, maybe a couple of quarters back, obviously the kind of increases what we have seen in the interest rate scenario and the NIM compression, that was not even there in the reckoning at that time. So we are confident about the range, but it will have an upward bias. I think 58% perhaps, 57.5 to 58.5 kind of range perhaps we can think of. That over a period of 12 months. I am not talking about quarter to quarter. Because as I said, like the festival spends again are spilling over to the month of October, November, December quarter as well. So obviously we said like it will continue to remain elevated, but that will not be the case coming to Q4. Then it will be lower. So over a period of 12 months, when you average it out, it will be hovering around maybe 50 basis points here and there, around 58% actually.
Understood. And on the question of cost of funds, 50 bips, 50-60 bips QOQ increase, is that correct?
No, I think what sir said was that 5.4 which we are seeing is little colored. The actual number, taking out the last week's borrowing and the denominator effect will be 5.7. So on top of that, it will be 50 to 60 basis points higher.
Okay. So sequentially, you could see like around anywhere between 80 to 90 basis point increase QOQ. That's the kind of magnitude we could see.
Yeah, Dhaval, we have to think it from the perspective that in Q4 we were at 4.9, right? What you're seeing right now is 5.4. This is just a 50 basis point higher in 6 months. However, the rates have gone up by 190 basis points already. So the impact is not visible, and it's colored, as we are saying, because of the last week's borrowing. Right. The full borrowing cost impact has not come in the quarter. That's the reason it's 5.4. However, it should have been in the range of 5.7 for the quarter. And this in next quarter will go further higher.
Understood. And we are saying NIM to be stable because of the optimization on the mix to offset the cost of fund impact. Hence, NIM could be plus or minus 10-20 bits on a sequential basis.
What I alluded to was more like we're confident of managing it around 12%. At least we're confident of keeping it around 12%. But definitely it will be lower than 12.3 given the kind of pressures what we are seeing.
Got it, sir. Very, very clear. Thank you and all the best.
Thank you. Ladies and gentlemen, that was the last question for today. I would now like to hand the conference over to Mr. Rao, MD and CEO of SBI Card, for closing comments.
Yeah, Faizan, I would like to thank my colleagues at SBI Card for their continued commitment, hard work, and support that have contributed greatly to our continued success. I'm also grateful to our shareholders, investors, and business partners who have believed in us and supported us throughout. Lastly, I would like to reiterate our confidence in our agility and adaptiveness, which has helped us ensure sustainable and profitable growth. Wishing you all a wonderful festive season. Yeah, thank you and good night.
Thank you. Ladies and gentlemen, on behalf of SBI Cards and Payment Services Limited, that concludes this conference call. Thank you for joining us, and you may now disconnect your